Happy Friday, everyone. Thanks for joining us today on this edition of Business Daily. I'm Lee Ji-yoon in Seoul. Let's get started with a look at the day's highlights. Korea's consumer sentiment rebounds in February after dropping to its lowest level since the global financial crisis. The Trump administration wants to boost economic growth, and to do so, it's turning to tax code revisions and new immigration policies, setting off various concerns. These stories and more coming right up. Adding to concerns of slow economic growth here at home, Korean households' real income and spending backtracked last year compared to the year before. Statistics Korea says Friday that an average Korean household made some $3,800 per month last year, up 0.6% from the year before. That's down from the 1.6% growth posted in 2015 and is also the slowest gain since related data was compiled in 2003. Adjusted for inflation, real income slid 0.4%. Real household consumption also dropped 1.3% to an average of $3,100. With more Koreans tightening their belts, the ratio of private spending to disposable income came in at 71.1%, down nearly 1 percentage point on year. Korea's consumer sentiment improved in February for the first time in 4 months. The Bank of Korea attributes the uptick to stronger exports, but warns that it's too early to tell whether this is the start of a turnaround. Our Shin Se-min has this report.
A key indicator for people's outlook on the nation's overall economy is showing signs of improvement after a 3-month slide. The Bank of Korea's Composite Consumer Sentiment Index for this month came in at 94.4, up from 93.3 recorded in January when the figure hit its lowest point since March 2009. The index had hovered above the benchmark from July to October last year, but took a nosedive in November and continued to slide through the first month of this year. Despite the slight uptick in February, the index still sits under 100, which means pessimists outnumber optimists. Within the composite index, figures show sentiment toward current and future domestic economic conditions rose by 4 points and 3 points, respectively. The outlook on prospective employment opportunities inched up 1 point on month. The improved sentiment comes amid cautious signs of economic recovery driven by rising exports, which posted 3 straight months of growth as of January. Despite the slight rebound, the Bank of Korea notes that the figures still reflect pessimistic views across the board, and it called for close monitoring of future indices. Shin Se-min, Business Daily.
And moving on to markets, to give us a wrap-up of this week's stock market action, we have our Business Daily's markets contributor, Choi Jin-seok, joining us on the phone today. Hello, Jin-seok.
Happy Friday.
All right, so as we close the week, how are things looking on the last day of trading?
After a decent rally throughout the week, the Korean equity market lost its steam on the last session of the week. The Kospi fell by 0.6% to close at 2094.12, while the Kosdaq followed with a 0.4% downtick. The Kospi market opened the session slightly down due to the sell-off by institutional investors, but the index still stayed above 2100. However, as foreigners shifted their position to sell as well, the index failed to keep the 2100 level during late hours. The U.S. stock market overnight continued its positive trend, with the Dow Jones Industrial Average breaking all-time highs for 10 consecutive sessions. However, the technology sector fell sharply due to weak earnings reports. The same sector on the Kospi market suffered from a plummet as well, spooking sentiment in the overall market. The Kosdaq market opened the session with a positive picture, but the index also fell into negative territory due to the sell-off by institutions.
Now then, how was the overall weekly performance? I mean, aside from today's drop, the market has continued to rise throughout the week.
On a weekly basis, the Kospi market enjoyed a more than 0.5% rally, while the Kosdaq fell slightly. The Kospi index rose above 2100 for the first time in 19 months on Tuesday, as the so-called risk appetite has been revived throughout global financial markets. A relatively undervalued Korea market benefited this week. Projections from experts on future market directions are still mixed, though. Some experts predict the Kospi index will break through 2,200 in the first half of 2017, citing improving global economic data and potential stimulus measures implemented by the new U.S. administration. However, other experts are still cautious, and they say if upcoming policies or economic indicators fall short of market expectations, further upswings in global markets will be limited.
And after the recent release of the FOMC minutes, the U.S. dollar has continued to weaken. So tell us more about the main reason behind this and the potential impact the dollar depreciation may have on the Korean market.
According to the FOMC minutes, Fed officials agreed on raising interest rates soon during the latest meeting. However, experts still put the earliest rate rise at May or June because of the uncertainty surrounding U.S. President Donald Trump. That's why the U.S. dollar has been weakening. As a result, prices of U.S. treasuries and major commodities rose as well. And it's not only the U.S. dollar. The euro and the Japanese yen have depreciated against the Korean won as well. In particular, the euro fell to the lowest since April of 2015. In terms of capital flows from foreign investors on the Korean market, the weakening dollar is rather positive since foreigners tend to pull their money from the market if their currency value rises. Moreover, experts say even if the Fed raises rates in March, the potential impact on the market might not be entirely negative because another tightening move by the Fed reflects improved economic conditions in the U.S. Therefore, it will be still worth watching to see if the Korean stock market will continue its rally despite today's drop. This has been Choi Jin-seok for Business Daily.
Korea's big business lobby, the Federation of Korean Industries, has announced that Chairman Ho Chang-soo will stay on as head of the organization for another 2 years. Members voted to extend his term at a time when the group faces one of its biggest crises in 56 years since establishment. For major conglomerates Samsung, SK, Hyundai Motor Group, and LG, who accounted for nearly half of FKI's funds, have recently withdrawn their memberships. This is after questions were raised about massive donations they made to two dubious foundations linked to Choi Soon-sil in the ongoing corruption scandal. Ho, who is also the chairman of GS, apologized for causing trouble and vowed a complete transformation of the organization. He pledged to root out collusion between companies and the government, enhance transparency of the group, and strengthen its role as an economic think tank. Over the years, the term spoon class theory here in Korea has made its way into daily dialogue. It reflects the belief that people's lives are determined by family wealth and background, and recent surveys show that this notion is making many question their own upward mobility. Our Lee Joo-young has more.
In Korea, it's not a select group that's born with a silver spoon. For the luckier, there's a gold spoon. For the less so, a bronze spoon, and for the least fortunate, a dirt spoon. Many people increasingly see their fates dependent on how rich a family they are born into. While education had once served as the greatest vehicle improving one's ability in climbing up the social ladder, now that's being replaced by the notion that family background and wealth trump personal achievements. This is increasingly frustrating many in the lower strata who feel that it's harder to break into higher income brackets. According to a survey by Korea Institute of Public Administration conducted on 8,000 Koreans aged 19 and older, less than 50% of the respondents thought that their efforts made a difference in cutting across social classes. This is down 12.5 percentage points compared to 3 years ago. The survey also revealed that the ratio of parents who believe their children have a chance to move up the social ranks with their own abilities slid to 56% last year from what was 70% back in 2013. The ratio of those who answered it would never be possible also more than doubled. Experts say with an increasing number of people feeling trapped, the government should make job creation the top priority and offer more financial assistance to youth from lower-income families struggling to land jobs. They add that the government should take this growing disbelief in upward mobility more seriously and consider issues of social equality when drafting policies so that more people can enjoy the fruit of self-made success. Lee Ju-young, Business Daily.
Time now for a look through some notable global business stories from the week, and we're joined by Eunice Kim in the studio for that. Hello, Eunice.
Hello.
All right, so we're a little over a month into Donald Trump era, and his cabinet is slowly coming together. Now, we're starting to get an indication on when we could see the fiscal plan that markets are so hopeful about.
That's right, and it looks to be not for a while. You know, President Trump's Treasury Secretary Steven Mnuchin has been very busy meeting with leaders from home and abroad since his confirmation last week, and it doesn't look like we'll get much detail on the Trump reflation until the second half of this year. Take a look.
Judging by the continued rally on Wall Street this week, you'd think America was on track for white-hot growth. That's certainly what the Trump administration is aiming for, specifically sustained economic growth at above 3%.
Our economic agenda, the number one issue is growth, and the first most important thing that will impact growth is a tax plan. So we are committed to pass tax reform. It will be very significant. It's going to be focused on middle-income tax cuts, simplification, and making the business tax competitive with the rest of the world, which has been a big problem and a lot of reason why companies are leaving and cash is sitting offshore.
Treasury Secretary Mnuchin adds he's going to get that tax plan under negotiation with Republican lawmakers by a, quote, ambitious deadline of August, though it could slip to later in the year. But a question, what does it take to reach a 3% growth goal? That's a significant step up from the Federal Reserve's projection of 1.8%, an outlook echoed by the Congressional Budget Office. The administration is betting cutting taxes and boosting government spending and possibly a border adjustment tax will get America's economy to run hot again. But will it be able to do so without key trading partners like China and Mexico? Top diplomat Rex Tillerson and the head of Homeland Security John Kelly met with leaders in Mexico on Thursday, but officials there said they saw little progress in bridging their divide. This comes as the White House has postponed a release of its new executive order on restricted travel to next week. Some industries in the U.S. are already bracing for impact, as it's no secret that undocumented Mexican workers are a force in the economy. While their number has plateaued along the 8 million line over the past decade, the Pew Research Center estimates undocumented laborers made up at least 17% of agricultural workers in 2014, a figure the U.S. Department of Agriculture puts closer to 37% now. Companies in other industries like construction and hospitality are also concerned of a coming labor shortage should the Trump administration's rhetoric drive away Mexican workers forcibly or voluntarily. Also, the world's largest economy is facing an increasingly aging population. Population growth has fallen to a historic low of 0.4%, and should immigration be pulled back from current projections, the ratio of residents 65 years and older stands to be pulled up, making entitlements like Social Security more costly for the working population. Economists will tell you, without a sizable population and productivity boom from current levels, achieving a sustained 3% or higher annual growth rate is nothing more than a pie in the sky.
And so far, it seems that we're seeing President Trump's cabinet members are pulling him back from his aggressive rhetoric, but we will hear from Trump himself come next Tuesday.
That's right. That's when he will address a joint House of Congress, which will be televised live on Tuesday. And White House aides say that his speech will be more detailed on his priorities, a step away from what we saw in his inaugural address last month. Now, as recently as Thursday local time, we heard from President President Trump, calling China the, quote, grand champions of currency manipulation, according to Reuters, even if his administration has not labeled Beijing with the title yet. His Treasury Secretary Steven Mnuchin has said he will leave it up to the process to determine that, which is expected to come in April. This as there are reports staff are working behind the scenes to arrange President Trump's first meeting with China's President Xi Jinping, which would come in July on the sidelines of the G20 summit in Germany. But if the new U.S. leader skips the multilateral meeting, the next opportunity could be at the APEC summit in Vietnam later on in the year.
And lastly, an interesting survey has found that the #1 destination for millionaires around the world was a country in the Asia Pacific.
That's absolutely right. And we are talking about Australia. That country came on top of a list compiled by a research firm called New World Wealth. It said in the year 2016, an estimated 11,000 millionaires moved down under, up from the 8,000 who had moved there in 2015. Researchers say Australia edged out past favorites, the U.S. and the U.K., for the country's distance from the refugee crisis stemming from conflicts in the Middle East. Its proximity to emerging economies such as Korea, China, and India, as well as a solid healthcare system, also had an impact. Meanwhile, more than 12,000 millionaires left France last year, putting its net outflow at over 60,000 since the year 2000, June.
Now, I've never been to Australia, but hearing this, I definitely want to visit it at least.
Why not?
All right. Thank you so much for coming in today.
You bet.
And that wraps it up for today and this week. Thanks so much for watching. We'll be back next week with more at the same time, same place for your Business Daily. Until then, goodbye.